So what's up, YouTube? My name's Jim Langston, and I've got $1 billion secret that I'm going to pass along to you today. Let me say though, starting out, I have personally benefited from watching hundreds of YouTube videos, whether it's on repairing my mower or the refrigerator or washing machine or the car. I've always come across some dude who's had the same similar problem and filmed it and shot it up, and I benefited from that. So I guess here I am doing the same thing. So I'm kind of passing along what I'm an expert in, and nobody may watch this. Maybe it goes viral, but I'm going to speak from the heart, and I want to get this done in one shot. This is probably my 60th take, and I keep redoing it because I get a word wrong, or I look down, or an email pops up on my computer and my eyes jet over there. So it's not going to be perfect. I'm not a videographer. I'm just going to do the best that I can do. But the information that I'm going to pass along here today is valuable. And we're talking billions and billions and billions of dollars. And I'm a little bit of an emotional kind of guy. I guess creating this video is one last take. This is it. Probably 15 years of my life. I just gotta get this out. I'm gonna finish this. And I don't want to take this video again, so bear with me. So, the $1 billion secret that the financial services industry doesn't want you to know, or your investment advisor for that matter, is that when you go to invest with an investment advisor, you've got multiple options in terms of how you pay for that investment advice. Excuse me, I'm going to get through this. And that, honestly, that goes to the heart of what that secret is. That you go sit down with the gentleman at your brokerage firm, or the broker at the bank, the investment advisor at the bank, and you've got $50, $100, $200,000, you're just retiring, and you've got a 401k that you're rolling over. What they fail to adequately educate you, inform you to, is there are multiple ways that you can pay for that investment advice. Choose the wrong one, the wrong option up front, and you can easily be overcharged tens of thousands of dollars. Now, those numbers really, they're not coming from me. There was a report released by the United States Department of Labor where they concluded their study so that investors, just retirement investors, so we're not talking all the retail brokerage accounts, but just retirement investors are overcharged $17 billion with a B on an annual basis. Now, for the longest time, I've tried to get the financial media, press, to buy into what I'm basically conveying to this video, what I'm giving to you. But people could never get their head around it. They were just like, not billions of dollars. It is. It's literally billions of dollars. And it's enabled or sanctioned by the very industry that profits from it, in terms of them am I ever going to get through this? So I guess what I'm trying to say is the most common feedback I get is, that's not possible. That's what I'm trying to say. How is it possible that American investors are overcharged $17 billion plus a year. It's because it is technically disclosed to you. I mean, that's the key, is the information is included in the prospectus. Now, if you went to law school, then you have a better chance at understanding it, but still, you're not really gonna appreciate how these options work and the significance of making sure you choose the most cost-effective option up front. Because if you don't, what's gonna happen is 10 years later, you're gonna run into me and I'm gonna do what's called a cost differential analysis of your portfolio. And I'm gonna say, Miss Mary Jane, you've been overcharged $25,000 because your broker put you in the wrong share class or the wrong fee-based account. And at that point, it's way more difficult to correct the problem because most brokerage firms are going to say, we disclosed it to you, you agreed to this, you got the prospectus, you could have read it, you could have figured this out, but you didn't. So see you in court. And then you're going to have to go hire a securities lawyer for, $300 an hour to file an arbitration complaint. And the firm that you're suing is going to fight you, and they're going to go hire a couple attorneys, and it gets complicated. So that's how they get away with it, because you were given a prospectus, you were given various disclosure documents that you probably had to sign, and basically what they were saying was, this is your choice to buy this share class or this fee-based account. We tried to warn you, and you still wanted to buy that mutual fund, so you got screwed. They take that document with you. So that's how it happens. So what are the various, and to cut to the chase here, what are the various options and how is this all sold to you? So when you invest in mutual funds, there's two types of mutual funds for the most part. And I'm not going to try to, teach a class here. I just want to get across the bare minimum of what you need to understand that will empower you to ask the correct questions. And also, I guess, I kind of jump around here as my brain works. I just released a series of books. And these books basically are going to provide further detail on what I'm explaining here. And they're so cheap. They're all basically less than $4 on Amazon. I mean, less than a cup of coffee. And so kind of what I was getting emotional about earlier on is it took a long time to finish those books. And honestly, I came up with this whole idea. I uncovered the $1 billion secret 15 years ago, and here I am filming this video. So that's kind of the emotional. A lot has gone into getting to this point. And I start thinking about all the years and I just get choked up. So I'll try to stay on point. So the various mechanisms by which you are overcharged and you don't know it because you have options. That's the industry likes to tout that we give the investing public options in terms of how you pay for investment advice. But what they fail to adequately inform you to is that how these options work and how choosing the wrong option can cost you thousands and thousands and thousands of dollars over the life of your investment. Now, when I say cost you, it's not just money that just goes out of your pocket, it's money that's paid in commissions. So you can either have that money reinvested into your portfolio, or you can pay that money out to your broker, the brokerage firm, as commissions. I think most people are going to want to keep that money and allow it to compound more quickly. So when you invest, starting out with mutual funds, and then I'll briefly touch on fee-based accounts. And again, I'll provide the links in the video below, which I've always watched these YouTube videos and they always say that. I think it's funny that I'm now saying that. Check the link below. Funny how everything comes full circle. So I'm just gonna, to make this as brief as I can, and I do tend to ramble on, and I do tend to repeat myself, which is why I kept doing these, recutting this video and I got to the 50th or 60th time. I'm just going to shoot this one time, leave all the screw ups and the scars in the video, and you can take it for what it's worth because it's free, right? You had to watch the ad, and that's it. But what I'm telling you here, your investment advisor not going to appreciate it. So when you're investing in mutual funds, there's generally two different types. There's a no-load fund, and then there's a load fund. The load fund is what most brokers sell. You pay a commission, goes to him, he gets a percentage of it, and the other percentage goes to the firm he works for. A no-load fund is much cheaper than the load fund because there's no commission, no load, no commission. But there's still fees embedded in no-load funds, and that's going to be the key here. So over the last 25 years, most people have been sold what's called load mutual funds, and that's going to be the A share, the B share, and the C share. And the fact that there's three different, and actually there's more shares, there's an M share, and there's all kinds of share classes. But those are the most common shares that have been sold, and I guess I'm referring to over the last 25 plus years. I guess a brief history on this. So generally the A share was the most common share historically 20-something years ago. But the A share wasn't as initially as popular with the public because the way the A share works is there's an upfront fee that's charged to you. And it's transparent, it's reflected on your first financial statement, and you see it. So let's say you invested $100,000 and the A share charge was 5% up front. So you get your first financial statement and it's going to say you own $95,000 because you just paid a $5,000 commission to your broker. And I guess the industry quickly figured out that most people are price sensitive to those types of commissions. And so really what happened was there was a net outflow of capital from the markets. I don't know for what reason, it's just based on my studies, that's what everybody has said. And so what the industry was trying to do is come up with more creative ways to finance these, I say finance, funny enough, because you are technically financing it. Coming up with more creative ways for you, the investor, options to pay for investment advice. So they came up with what's called a B share and a C share. Now, what was clever about these B and C shares was that the fees, the commissions, were paid directly from the mutual fund company. Now that was unique. So you had $100,000 now, and you invested, your broker sold you a B share, which all the disclosure was in a prospectus that was mailed to you or sent home with you. But what you failed to appreciate was when you invested in that $100,000 and there was a 5% commission, well, that commission was now being paid by the mutual fund company to the broker on your behalf. So you're now obligated to repay that. So, and I'm looking at the timer here, I'm already at 13 minutes. But this is important. I mean, this is money in your pocket or out of your pocket. So if you can stick with me here, most people are going to walk away from this and call their broker and say, hey, can you explain this to me? So I'll try to speed this up. So with the B share, you invest $100,000 and it's a 5% commission. It's called a contingent deferred sale charge, CDSC. So that 5% is paid from the mutual fund company to your broker on your behalf. And that's the key. You're now responsible for repaying that $5,000 plus interest that you really didn't appreciate you were paying. Now, the clever part about the B and the C share is, since the mutual fund company advanced that money on your behalf, it was a loan. You just borrowed that money and you pledged your asset as collateral on that loan. It's not reflected on your first financial statement. So you remember with the A share, you invest $100,000, you get your first statement, and it says you only own $95,000 because you paid a $5,000 commission. With the B share, what they do is, since it didn't come out up front out of your money, it's a debt you borrowed the money, you borrowed that commission. Your first financial statement says you have $100,000. So the industry quickly realized it's a lot easier to sell a mutual fund where it doesn't appear commission is paid, as opposed to that A share where it's transparent and it's taken off the top, but people tend to push back. Now, again, my mind jumping around here, the trade-off is that even though you paid that upfront commission, which most people weren't happy about, the annual ongoing fees are significantly cheaper. So in the long run, it's cheaper for most people to pay the upfront transparent fee and pay a lower annual fee going forward than it is to invest in that B share where you borrow the money and you have to repay it, plus, in essence, plus interest in terms of the way I've calculated it, and that is the way it works. So the B share was really popular, and billions and billions and billions of dollars were sold in B shares. Well, eventually the industry and some academics began to kind of question whether or not that was an equitable way to sell investments, because they really were kind of conning you, because the impression was given to millions of investors that there was no commission paid as long as you didn't sell that investment during what they call this holding period, whether it's 5, 6, 7, 8, 9 years. That's not true. That's not how it works. You're borrowing that money. You've committed to repaying that. But that's why they came up with the name contingent deferred, because they're insinuating, and they're not even insinuating, they're really saying this, that commission is contingent on some future event. It's deferred to another day. And that ain't how it works. You've borrowed that money. You're financially committed to repaying that, whether you're in it for a day or you're in it for 10 years. You borrowed $5,000 in that scenario. And a lot of times it's significantly more. That upfront advance commission could be 5, 6, 7, 8, 9, 10%. And you're not going to squawk about it. You're not going to squawk about the fact that you're having to repay that because you don't really appreciate that you've paid it or you've borrowed it, because it didn't come out of your pocket up front. It was advanced. So I think I've beaten that horse. So then the other share class is what's called the C share class. And the C share class is similar to the B in that it's got a 1% contingent deferred sales charge in the first year. So you've got $500,000 and from a 401k that you're rolling over, and in that first year, your broker's getting paid 1% of that $500,000. So that's $5,000 that was advanced on your behalf. You're obligated to repay that within the first year. And they tack on, there's an additional charge that the mutual fund company pays themselves in order to repay what they loaned you. Now, after that first year, what then happens with the C shares, you're paying 1% a year in perpetuity, forever. 1%. If you're in it for 5 years, you're paying 5%. If you're in it for 10 years, you're paying 10, 15, 20%. Now, again, the C share is similar to the B share because that fee is taken out at the fund level, mutual fund company, so you don't really see it. You don't see it because it's not reflected on your financial statement. And every year going forward, you don't see that 1%. So again, there are options. The options here are you could have invested in an A, a B, or a C. The problem is, for most people, if you're going to invest for more than 4, 5, 6 years, the A share is going to be the cheapest option. But brokers don't like selling them because the fees are transparent. It comes out up front. The problem is, as Dr. O'Neill says, there's a blatant adverse incentive. So the broker has an incentive to put you in the wrong share class because he makes more money. And not only that, but he makes the money it's easier to make because you're not complaining about what you're paying him because you don't really see it. And they fail to inform you, sometimes, allegedly, that the A share with its upfront charge is actually cheaper. But if I've got to come to you and say, you've got $100,000, you're going to pay me 5% of that, so $5,000 up front, and I've got to justify that to you, or I can put you in a B share and you don't really say anything about it because you don't really, the industry has convinced you that there's no commission paid as long as you don't sell it. Well, it's a lot easier to sell. So in essence, the broker is selling you the easier option, even though it's not in your best interest. And so what ultimately happens is millions of investors get overcharged billions of dollars. And the problem that the industry now faces is that they really can't address this, because in addressing it, they would be drawing attention to the problem that they created. They allowed these mutual fund companies to create these various options, and they allowed them to structure them so that the commission wasn't really disclosed to you. And so millions of people over the last 25 years plus have been sold the wrong share class, the wrong option, because the broker made more money. Now again, they can get away with it because all of that, what I just tried to explain to you, is disclosed in the prospectus. And if you could read Greek, if you went to law school, and if you're a former investment advisor, you would understand it. Short of that, you've got no idea. And that's how this has gone on all these years. And I figured that out 15 years ago as a former broker. When I walked away from the business, I wrote an algorithm that mathematically calculated the differential between the share classes. And it wasn't really until then that the light turned on and I was like, well, wait a second. As an investor, at the point of sale, you can actually, if we make certain assumptions about the variables that go into the algorithm, we can determine which share class is going to be most cost effective for you up front. So rather than you 15 years later being in a C share and all of a sudden you come meet with me and I do a cost differential analysis, and now we figure out you've been overcharged $25,000, and as I alluded to earlier, now you got to go hire an attorney, and you're probably not going to have $5, $10, $15, $20,000 to arbitrate it. The better course of action is to figure out which is the right share class up front. But again, since there's a blatant adverse incentive, your broker is paid more for putting you in the wrong one, the wrong share class. So I basically took that algorithm and reduced those results down to basically a graph that anybody can use. I mean, this is the point of sale tool that the SEC, the industry, has been unwilling, allegedly, produce, because if the millions of people that have been sold,
I didn't know that.
you see, that was my Amazon Echo. What? I'm gonna finish this. I don't care what happens. I'm gonna finish this damn video. I can move on with my life and feel like all the work I did, I shared with the public. That's all I can do. So what I did was I took the algorithm, and rather than running specific results for each individual person, which is time consuming on my part, having to meet with everybody, I came up with a standardized disclosure document that anybody can use to allow you to determine before you invest which of those options is going to be most cost effective for you. And not only that, but if you're already in your mutual fund now and you're not sure which option is most cost effective, the chart still works. You find your investment range across the top, and then your investment time horizon over here. Where they meet in this box is going to be the share class that you should be in. There's a dollar amount in the box. If you don't own the share class in the box, that's the potential amount you may have been overcharged. Now, it's just a range. It can't be exact because I'm not doing it specifically on you, but it's close enough to allow you to appreciate that being in that wrong share class has had a significant financial impact on you. And now you can go back to your broker and say, hey, explain to me how this works, and why am I in this share class? They're going to stutter and choke when they have to explain to you that you are in the wrong share class given your investment time horizon. But at that point, I guess you can reach out and contact me if I survive this stinking video. So the point of really coming up with a standardized disclosure document that anyone could use was that you could now take this. You could go, again, in the link, you can go to Amazon, and for less than $4, and less than $3, I think, buy my material. Take it to your broker, say, hey, let's talk about this. Circle the box that I should be in, and then your next step is going to be submitting my 5 simple questions. That's it, 5 questions, that's all you need. And you want to get the answer in writing. So submit it via email is probably your best bet. But I've designed those questions so that if you were sold the wrong mutual fund share class, they won't be able to answer it. So that'll be, I guess, your next red flag. If they refuse to circle the correct box, initial this page, and if they refuse to answer those 5 simple questions, then you probably have an issue with the account type that you were sold. And we're not just talking, $3 or $4. We're talking generally thousands of dollars on an annual basis. And if you take that, make some predictions about future value calculations, if you've got 10, 15 years out from your retirement, that's a lot of money. I mean, you're talking $20, $30, $40, $50,000. That's why I stuck with this for as long as I did, because the potential financial impact on most people is significant. And so I tried to get that point across for years with people in the financial media, and they never, ever got it. And it really wasn't until the U.S. Department of Labor released that report where they conceded that on an annual basis, $17 billion is being overcharged through hidden fees. And it wasn't until that point that I knew it had all been worth it and that I was right. 27 minutes, that's crazy. So that's a little bit on, so we're talking options here, right? So that's a little bit on mutual fund share classes. So the other account type is what's called a fee-based account. And that's probably even a little more insidious than the share classes in terms of how the fees are kind of hidden, manipulated. I would argue that the industry has moved towards these fee-based wrap managed accounts because of the liability posed by the share classes. Because if you can come back and say, I told you my investment time horizon was 20 years, and you sold me a C share class because I'm paying 1% a year, so that's 20%, right? Now I met with this guy, I saw his chart, and I now realize that I was paying 1% a year, and I could have paid with an A share, and let's say there are breakpoints involved, so the more money I invest, the cheaper it is for me to pay that upfront fee. It would have been significantly cheaper had you sold me that A share 20 years ago, and that cheaper amount is your overcharge. That's how much more you paid than you should have. You're talking $30,000, $40,000, $50,000 all day long. And so that's a liability. If you can then come back to your broker and say, in my new account application, you put on there in time horizon 20 years, but you still sold me a C share, you kind of got it, right? That's a liability to the industry. If you can afford a securities lawyer, you're probably at the end of the day going to win. So what the industry has done is they've gravitated towards these fee-based accounts because the feeling was that there's less liability there. But it wasn't until I plugged in an average fee-based account scenario with the no-load fund and compared it to an A share. So what I'm saying is I'm comparing, would it be cheaper for you to invest in a fee-based account or mutual fund A share classes where there's breakpoints and discounts for the larger your initial investment. So if you compare those two, as I did in the algorithm, it became clear that the fee-based accounts were actually more expensive than the share classes. Because what happens is, a lot of times, the fee-based accounts are billed sold to you as a cheaper option to the share classes. Because if you pay that, let's say with the fee-based account, you pay an annual ongoing percentage to your investment advisor. So it might be, let's say 2%. So then what they tell you is, well, now you can invest in these no-load mutual funds, and they're significantly cheaper than the load share classes, the A, the B, and the C. So you're paying me 2% a year, but now you have access to this large pool of no-load funds, and they're cheaper. So you're probably coming out ahead. Oh no. And not only no, but the industry is aware of this, because when I was looking into how these numbers work, I came across the FINRA regulatory body website. First thing when I basically searched fee-based accounts, first thing that popped up is a warning. They said you need to be careful when you invest in fee-based accounts, because the total cost of investing in fee-based accounts can significantly impact your overall returns. And I'm like, what are they getting at here? And what they were getting at is, most people are given the impression that they're cheaper, but because they fail to appreciate you're paying the 2% a year to your broker, and you're paying the mutual fund no load fee. So let's say that's 0.4% a year. So 2% plus 0.4 is 2.4% a year. Now you have to take that 2.4 and compare it to what the A share would cost you. But again, you're paying that up front, so it's transparent. You're going to see it. It's going to be painful, but the ongoing charges with an A share are significantly cheaper. And that's what people don't understand. And it's not really explained to you that way, because it's way easier to sell you 2% a year, and then you don't really understand you're paying the 0.4, so it's really 2.4, and the A shares up front, and you're going to complain about, I don't really want to pay you 4%, $4,000. So it's more difficult to sell. The problem is, repeating myself, that there are options. And since the industry has decided to offer you options, but yet has failed to adequately explain the financial impact of choosing the wrong option, I went ahead and figured it out for you. And that's what I'm getting at, is that's what's in the book. That's what, for a few bucks on Amazon, download whichever version you want. Take that to your broker, and that's one of the points that I try to make in the book, is that you don't need to understand anything that I just talked about, because I know this is not terribly interesting to most people. It's not a Tom Clancy novel, but it's valuable information that will put money in most people's pocket. I mean, we're talking, if everyone in the country used this, and there's two of these. There's one for the fee-based accounts, and there's one for share classes. So fee-based, where I'm comparing the A share to the fee-based accounts, and there's one for mutual funds, the A, the B, and the C. So you pick which one of these you want to use, take it to your broker, say, explain to me why I am or why I am not in the right share classes in my box. If everybody did that in the country, millions of people, it would eliminate $17 billion. And that's just the starting point, because again, that doesn't factor in all the retail brokerage accounts. That's just retirement accounts. So it's probably $20 billion a year plus. And so, in all humility, and I kind of get into this a little bit in the book, and I guess I'm kind of trying to be a little sarcastic there. In all humility, the content that I've created here is going to save billions of dollars. That's money that you put back in your portfolio that then compounds and grows that much more quickly for you. To date, I'm the only one who has this material on the market. And that's another story in 34 minutes. There's three groups of people that appreciate what I'm saying here. And that's academics who, if you buy my books, or Vindication is the one that has all the content in it. The other versions are a little more condensed, so they're a little bit cheaper, but $3-4. But Vindication has everything in it in terms of the background and how we got here today. But there's three groups of people that when I explain to them these charts and the books and the 5 simple questions, that there's 5 simple questions for fee-based accounts and 5 simple questions for share classes. But there's 3 groups of people that when I show them this, they generally choke. And that's academics that get the math behind this, the algorithm. They're like, yes, you're right. You can calculate which share class is most cost effective up front. Industry regulators that they enabled these options, right? They're the ones who said 20 plus years ago, you know what, this A share is not all that popular because people don't really like paying in your face fees, commissions. Apparently, people prefer to pay commissions when they don't know they're paying them, if that makes sense. In other words, you're less inclined to gripe about paying a $5,000 commission when you're unwittingly borrowing that money from the mutual fund company, and that unwittingness is reinforced through the disclosure documents that clearly give you the impression that no commission is paid unless you sell that investment within a given period of time. And that just ain't how it works. You're borrowing that money and it's being advanced at your behest, and you will not, you're pledging your asset as collateral on that loan. So you got to bear that in mind. If you invest $100,000 and $5,000 was advanced on your behest unknowingly, you only owe $95,000. You try to get that money back from the mutual fund company and they're going to send you back $95,000. That's because you borrowed that money. It's not contingent, it's not deferred. So my point is, industry regulators, they get it because they created it. Academics get the math behind it, but they don't get the potential size of it. And that's why really I'm the first one who's ever come out with this. If you buy my book, Vindication, you'll see Dr. O'Neill and Dr. Lori Walsh, both of them obviously PhDs. Their academic papers confirm exactly what I'm saying. But I came up with my stuff independently. I found their research after, but it affirmed everything that I mathematically showed as well. So, academics, industry regulators, and investment advisors. So, none of those groups of people have any vested interest. The academics, they don't really get it, but industry regulators and certainly investment advisors have no vested interest in disclosing this. My point is, that's why I'm the first one to release a video like this. That's why it's taken 15 years. That's why I tear up when I think about how difficult this has been. I'm not shooting this video again. This is it. So however this comes across is how it comes across. But I know that what I've created here, my daughter may be the only one that sees this, but I can feel like I finished it. I got the books out. I've been in various USA Today and some other publications where they've kind of talked about share classes and some of the peripheral issues, but I can never get the buy-in in terms of the big picture. We're talking billions of dollars. And people just don't know it. And that's the key, is that's how they've gotten away with it, is because nobody has any appreciation that you were sold the wrong share class. And you never will unless somehow this video goes viral. That's the only like I'm a YouTuber. But I can't control that. All I can do is feel as though I completed this project and I can move on. So that's what you'll find in the links. The links to the books on Amazon. $4. Now, I will say, 40 minutes. And I could go on another couple hours. But what I'm trying to do here, I guess maybe pay back all the YouTube videos that I've seen over the years. People help me. So if you bear with me, the information I'm sharing with you is quite valuable. And honestly, you only need to fix this once. If you take these documents to your broker, your investment advisor, the guy at the local bank that sold you some large cap mutual fund, but you didn't realize, when you got that first financial statement, you saw a C on there. You didn't appreciate what that C meant. That C share class, that means you're paying 1% a year for as long as you own that. And if you're in your mid 30s, mid 25s, and you're not going to be using that money for the next 20 years, do you want to pay 1% a year? So 20%? Or would you rather be in the A share, the upfront fee? So you're going to pay, $50,000, you may have to pay $1,500, $2,000 up front, but the ongoing charges are significantly cheaper. So you'll make up, within a matter of 3 or 4 years, you'll make up for that upfront fee that you had to pay, and then your money will grow exponentially more quickly. And actually, the calculations on these charts factor all that in. So whatever share class is in the box that you go to, I've already factored in that with the A share, that money comes out up front. And then we make certain assumptions about annual returns of, let's say, 4 or 5%, whatever it is. But everything is on the same plane. So if it says C share is most cost effective or an A share, all those variables, breakpoint discounts, conversion years, have all been factored in. I can go on for hours on this. But my point being, I'm trying to provide as much value as I can in the next 5 or so minutes, because I think probably 45 minutes that's certainly my attention span. I'm already getting tired. So what you want to make sure is that you're in the right A, B, or C mutual fund share class, or if you're in a fee-based managed account, consultant account, you want to make sure that it's not cheaper for you to have been sold an A share with breakpoints than to be in that fee-based account. And those people are going to find it would have been significantly cheaper to be in the A share. My point being, go back to your advisor and say, hey, now I understand how this works. One, why didn't you at least give me the option, right? Because that's the word the industry likes to use, is options. You have options in terms of how you pay for investment advice. Well, if an option is inherently bad, as the B share is, and I don't even have time to get into all that, but if an option is inherently bad, it's not really an option, is it? I mean, it's more of you were tricked. But I told you about it because I handed you a prospectus, and you understood. You walked out the door with that prospectus, and you chose not to learn Greek, or you chose to not go to law school. So that's on you. You should have known that was not what you're overpaying significantly by buying that B share. So my point is, you want to make sure that you're in the right mutual fund share class, or you're in the right fee-based account versus an A share mutual fund. Those two things will save billions of dollars. And really, it's just asking those questions. And that's one of the points I have in my papers here, my notes. Really, the choice you have is to either maximize your returns or maximize your broker's commissions. And that's one of the other things I've struggled with over the years in trying to get this story out, until I finally was like, I'm just going to do a YouTube video, and whatever happens, happens. I can't care more about if you're in the right share class than you care. But I can tell you being in the wrong one is causing billions of dollars in hidden commission payments that could be going back into individual investors' accounts. So what else? Okay, so this is briefly, I'll delve into what's called C-share conversion issues. And I guess when I say that, I'm certain that some industry regulators are going to find this video and choke when they hear me start talking about this. But so what I alluded to and what you'll find in my charts is that a lot of people, millions of folks, have been sold a C share class when it would have been cheaper to invest in the A share class. In other words, a broker can make 1% a year for 20 years, 20%, or can sell you an A share and make maybe 3.5% up front and then make significantly less. And if you don't know about my matrix, you're never going to figure it out. There's just no way. So millions of people were sold the wrong share class. And what's happened, they were sold the C share class, being the wrong share class, for long-term investors. So what's happened is the industry has tried to quietly address this because, again, we're talking liability, right? That's why they went from mutual fund share classes to fee-based accounts, because it was the liability of, if somebody one day figures this out and we get a $1 billion class action lawsuit, it's going to look awfully bad when the attorneys serve discovery on us and there's a bunch of emails out there of us talking about, and I'm talking about the mutual fund companies now. If they get sued and now these mutual fund companies have all these internal emails where they're talking about, yeah, we know that we've got 300,000 investors on the books in C shares and they've been in there for 20 years or 15 years, paying 1% a year, and we're not doing anything about it. Well, that's going to look bad, right? I mean, that's called liability. So that's where the fee-based accounts and the issue with that come in. But my point being, so what's happened with the mutual fund companies, this is what I'm alleging, right? They became aware of this liability, and so what they're doing now is called forced C-share conversions. So they're taking all of their internal investors that have been in a C share for say 7, 8, 9, 10 years, and they're taking them out of the C share and putting them into the cheaper A share. Now, if you were to ask me, I'm going to say that's somewhat of an admission of guilt. I mean, you're now kind of acknowledging that you're aware that all these investors have been in that C share for way too long. I guess my question is, this is my point I'm getting at. So if you, the investor, if you got some notice from your brokerage firm that your C share has now been converted to an A share, you're going to want to ask, well, why wasn't I originally sold the A share class? Why did you sell me the C share? Now they may counter with, well, we didn't realize you were a long-term investor. And that's going to be the key for you to protect yourself, because that's one of the things that are originally asked on a new account application is, what's your investment time horizon? 5, 10, 15, 20 years. So if you said your time horizon was generally, let's say, greater than 5 or 6 years, let's just say you said 10, and your broker sold you a C share class, that's going to be a problem for them, because there's no question that that's the wrong share class. That means you were overcharged and you paid too much, and technically you're entitled to a refund. And that's maybe where I'll end this, because I'm at 48 minutes. So forced C-share conversions, major issue. Mutual fund companies converting all of hundreds of thousands of investors that have been in C shares for too long into the lower costing A share, which just proves my point that my calculations are accurate. And had you had this document at the time you invested, that wouldn't have happened to you. The broker would have had to say, okay, based on your investment time horizon of 10 years, it looks like that A share class is the most cost effective. So they couldn't have even sold you the A share. They couldn't have even sold you the C share had you had this. And that's the power of this, because what you do is you have them circle the box and initial the document and then answer the 5 simple questions. And you're protected. If, 5 years, and let me also say this, both sides are protected, because now you can't come back 10 years later and say, I said my time horizon was 5 years when it really was 10. So the broker can pull this out and say, hey, well, wait, we both initial signed this, and that's not what you told me. So really both sides are protected. And that's another thing. I'm not saying investment advisors don't deserve to be fairly compensated for their work. That's not the point. My point is, if you're going to provide options to investors, then you need to be transparent about the ultimate financial impact of the various options, the A, the B, the C, or a fee-based account, and put it all on the table and say, this is how you're going to pay for this. One way or the other, it's not free. And in being transparent with you, I'm then allowing you to choose the option that's going to maximize your returns, right? That's all I'm really getting at. And that's 50 minutes into this. That's what I'm trying to say. It's all about maximizing your annual returns. It's about transparency. It's about the broker being fairly compensated. And it's not about gotcha salesmanship, which is what's happened over the last 25 years, because they could sell you whatever they wanted because it was all disclosed in a prospectus. And that's really kind of where I came up with the idea for my standardized disclosure documents. Was I'm like, hey, wait a second, I can come up with a point of sale tool that anyone can use, and it will eliminate the billions of dollars in annual charges. So since I made it this far without having to recut or retake any of this, I guess I just want to make sure there's nothing that I want to add in. If you decide to buy any of the books, you're going to find that while the Matrix has 5 general simple questions, I provide another 50 or so questions you're going to want to use. And let me briefly also say, the idea behind the questions came from, I would have clients, like I would explain to somebody, say, hey, listen, you're in a fee-based account, or you're in a C share or a B share, and it would have been significantly cheaper. In other words, you overpaid $15,000, $20,000 by being in the wrong share class. What inevitably would happen was these people would ask me, well, can you call my broker and find out how this happened? And I always felt I was being disingenuous or dishonest by playing that game, by acting like I'm somebody's brother or husband. So I thought, why don't I just come up with a series of questions that I would ask, give them to you, and then you just email your broker. And when they get the questions, they're going to be like, well, how do you know how all this works? But if you submit them, then they're going to have to respond to you in writing. And that's the power of that. So I thought, well, why don't I just come up with as many various questions as I can think of that I've had to pose over the years and put them in the book. And it's actually pretty powerful when you see it. And also, obviously, the matrices, if that's the plural for matrix, are in the book. And then I provide what I like to call breadcrumbs. And I'm not going to get into all that, but people that are into that line of work will understand why I put the breadcrumbs in there and what I'm alluding to. But in essence, that's probably what I wanted to get out today. Maybe I'll do another video. I don't know, but I think emotionally I've released whatever it was I needed to release, and I put the world on notice. And it is a worldwide issue, to be honest with you. One of the largest clients that I did a cost differential analysis on was from South America. And this guy was overcharged easily $100 and something thousand from being sold the wrong mutual fund share classes. So, in other words, the broker could have sold him an A share class, and it would have been maybe $9,000 or $10,000. Instead, he ended up paying over $100,000. So my point being, it's a worldwide phenomenon where investment advisors are providing investors options without adequately informing them as to the ultimate financial impact of being in those options. And again, if you made it to the end of this video, God bless you. I know it's not terribly captivating, but my point is it's valuable. It's money in your pocket. Take the time, fix this once. Take the time, if you want to buy my book, miss out on a cup of coffee one morning, uncover whether or not you're in the right fee-based account or the right share class and fix it now. And then you're done. And then you don't have to look at this video again. You can throw the book away. But if it saves you $10, $15, $20,000 or more, then it was time well spent. And I think that's about all I have in me, 55 minutes. So to YouTube, that's called passing it forward, is it? Is that the terminology? Pass it on? That's what I just did. For all those self-help videos on changing spark plugs or the head gasket seal or issues with the dishwasher, I just paid you back. And let me say also, in terms of the YouTube world that may find this video, the people that really need this more than any are more the millennials, the younger crowd who are just starting to work at a company or starting their first IRA or investing in a 401k at the company they work at, because that's the critical time to get in the correct share class. Getting in the wrong share class up front, it's going to cost you money, and then it's going to cost you money to try to fix the problem. So spend a few bucks, figure out which share class you should generally be in going forward, and then put the book away and, maybe take it out every couple of years if you're assigned a new investment advisor, because that is the power of all this, is if your broker doesn't appreciate that you understand how all this works, then he or she is more empowered to do whatever they want, if that makes sense. Power is knowledge. If you walk into your investment advisor's office and pull this out in my questions, they can't sell you whatever investment they want. They have to sell you the one that's going to maximize your returns, because now you know. If they don't think you know how any of this works, that's the one that's going to get overcharged $20,000 or $30,000. So that's the power of this. Is that if your advisor knows, and this, I touched on this I think earlier, but in the book, you don't have to understand how all this works. You just want your investment advisor to think you do. And that's all you need. Because an advisor is not going to sell, it's the theory of if an investment advisor knows a client's an attorney, as a general rule, the level of disclosure goes up significantly. All the I's are dotted and the T's are crossed. Nobody wants any trouble with that. That's the same case with my books, is if an investment advisor knows you have access to that and that you understand how all this works now, they're not going to sell you a B share or a C share or put you in a fee-based account that has a 2.5% annual charge plus the 0.4%, so you're almost paying 3% a year. They're not going to sell that to the guy who walks in with my material, because you're going to say, well, wait a second, that's not what I should be in, and are you trying to trick me? Right? Nobody wants that hassle. So that's the power of the transparency associated with this. 58 minutes. So I guess maybe I'll have an email in the description below as well if somebody wants to reach out to me. I have no idea how any of this is going to go over. I've probably repeated myself several times. If I did, it was for emphasis sake. Not that I'm getting senile, I don't think, but that's just the way I talk. I tend to repeat myself when I'm trying to re-emphasize a point. That's it. That's all I got. And I appreciate you watching. And thanks to all the YouTube videos, all the people that have made videos over the years that I benefited from. Thank you kindly, Jim. Now, I said I wasn't going to recut or cut into this video, but there was one thing I forgot to add. And that is, I guess, a thank you to Debbie and Abby, and more of an apology. that this took as long as it did. I did my best, and sometimes things just happen for a reason, and events take their own course. Sometimes it's hard to control how quickly ideas turn into reality. I think that's maybe from and I'm not necessarily artistic, but from a creative standpoint, you got to follow where the creativity goes, and sometimes that takes way longer than you would have ever dreamed. And that's, at the end of the day, that's why I guess I'm so emotional about all this, is that I feel like this was the last step, and that I've passed on my knowledge at this point. But they certainly, Debbie and Abby, have had to bear with a lot of financial difficulty as I followed this path. That wasn't their choice, it was mine. So I'm sorry about that, but I think with the completion of this video we can move forward. And thanks for watching.